Bank of America Securities, head of U.S. equity strategy. Savita Subramanian joins us now. And Savita, just on this conversation, do you think the market is too ahead of what the Fed is going to do on the cutting front, and that presents a risk?
You know, I think that there is some impetus here to quell market fears around a little bit of a softening that we're seeing in the economy. And admittedly, our economists have been calling for a deceleration, and we're seeing that now. I think the idea that we're going to see a real hard landing unless the Fed cuts excessively is not necessarily the story. So, you know, I would argue that what we're seeing is a reasonably, healthy economy. Is slowing. The Fed has controlled inflation. We are now at a point where the Fed can begin to cut rates. And that's actually good news for stocks because we're at a point where, a lot of the more cyclical companies are pricing in a really tough downturn. We've already started to see tech companies really underperform. I think probably the driver there is that hedge funds and mutual fund managers are essentially de-risking their portfolios of some of the leadership that may start to fade. But I do think that we're at a point where you don't necessarily want to sell the market wholesale. You want to pick your spots. And again, as you pointed out, I really like large cap value stocks here. I think that's an area of the market that's underappreciated and is poised to do quite well in the months, if not years to come.
Doesn't large cap value, doesn't any value need an economy that's in growth mode? And there are questions about that right now?
Indeed, that's a great point. So we do need an acceleration in growth in order usually for large cap value to outperform. And where we're seeing a bit of an uptick is maybe not in consumer spending trends or in services spending, but we are seeing an uptrend in some of the areas of the economy that have been in a recession, like manufacturing, like some of the infrastructure programs that have been a big contributor to economic growth over the last couple of years are starting to come back a little bit. So, when you look at the data, there are cross currents, and there have been cross currents for the last few years. Ever since COVID, we've been in this really disconnected market environment. And I think what we're seeing now is the slowdown in services, which was to be expected, and potentially a basing trend in goods demand. And we expect that to sort of kick in and drive earnings growth from here, as well as the fact that, and I pointed this out on your show a couple of weeks ago, the old school CapEx idea is really more of a must-do than a nice-to-do, because we're sitting on U.S. infrastructure that is incredibly old, hasn't seen a refurbishment spend cycle in a very, very long time. And meanwhile, we've brought all of this economic activity back from China to the U.S. So I think that there are a lot of drivers for a traditional CapEx cycle and a business investment cycle. Now, that's something new. We haven't seen one of those in a very long time. And I think that that's why investors are reticent to deploy new capital into large cap value. We haven't seen a large cap value cycle in a very long time, but I think we're really at a point where those types of companies are likely to outperform.